Joining me now to talk about what's trending in the world of finance and business today is Dan Fitzpatrick, founder of Stock Market Mentor. Dan, welcome to the Business Briefing.
Hey, Janet. Thanks for having me. I appreciate it.
So, Dan, the conversation we've been having over the past day or so is really centered on First Republic Bank, and that the markets just seem to be taking it in stride. It seems to have already been priced in, or a harbinger. I think market participants believe that the Fed will either need to pause or start pivoting soon. What's your reaction to the First Republic Bank takeover by J.P. Morgan Chase?
Yeah, I think it's overall it's a good thing. I mean, if nobody took it over, that would have been a real negative for the market. But in general, I think the market it doesn't surprise me that the market's taking it in stride, because that's what markets do. And they're kind of factoring in an unknown right now. And that is, it's what markets do. And overall, I think that we will probably see a bottoming in the regional banks, but just not yet. I think the market's already looking past that stuff, frankly. I know it's good for news. You'll see that stuff talked about on financial TV, CNBC, and Fox Business. I just don't think it's really a big deal anymore. Which I know is the minority view, but that tends to be what I do sometimes.
So, I wanted to hear more about that view. Why do you think it's not a big deal anymore? I mean, I think the general sentiment seems to be that there is, that risk of contagion based on the fears, based on potential continuation of deposit outflows, based on the fact that interest rates will remain high. Give me your contrarian take.
Yeah, the thing is, deposit outflows seem, at least the last that I've heard, yes, they're still going on, but they're not really accelerating. I think with respect to what this impact is on the market, I think ultimately it creates an underlying bid for stocks. Because where is this money going? It's coming out of the banks into money markets. It's sitting there essentially wondering where to go. I'm not saying that the fear of more collapses is non-existent. What I'm saying is it's already kind of factored in to things. That's what markets do. What a lot of people don't seem to understand, at least from my view, is an initial reaction to something big like this, like the SVB issues, is really, really big, and it's really, really fast. And then over a fairly short period of time, in the aggregate, all that's known, all that's imagined, all that's feared is factored into the prices of stocks. So I think ultimately what you really want to do is just focus on the price of stocks. And I think you just look at things like the KRE, the regional banks ETF, it looks horrible. And it's kind of one of those situations where what I always ask myself on stocks and sectors and markets that just look horrible is, the question is, oh my God, can things get any worse? And the typical answer might be, oh my God, no, things can't get any worse. Well, that's the time to buy. And I'm not saying that things will not get worse, but what I'm saying is they should not have a pronounced negative reaction to the market. I think maybe this sounds odd to say, but I think one or two more issues like Regions and like SVB will really be a cleansing effect that is going to really just kind of wash everything out.
So do you think that do you think there's a buying opportunity then in small and regional banks?
I really don't right now. But this is why. I'm a trend follower, and because of that, I like to buy stocks that are already going up. I don't really care so much about buying the bottom as I do buying stocks that start to trend strongly, because that's really where you're making the money. I think that if you look at the buying opportunities in the regionals, for example, they really, really fell hard in late March, March 13th was the big day. And that's the massive buying opportunity right there. Well, you've got a month and a half that's passed, And those prices tend to be even lower. So the question is, if you're buying here, it's a buying opportunity still. How much longer are you going to keep your money in there where it's not really doing anything? In other words, are you sacrificing making money for just buying the bottom and paying in terms of patience? And so, no, I don't see the buying opportunities yet. I think you'll hear fundamentalists, particularly even banking specialists, talk about all the buying opportunities. But when you ask them, okay, well, how long will we start seeing a rise in their stock prices, you will typically get the same thing, which is, well, you need to be patient. This is for patient investors. And when I see that, I say, okay, you need to be patient, but does that mean you're going to sit through more of a downtrend or just a lot of sideways, movement? And I think that we're going to see a lot more sideways movement.
Yeah, I think so too. Unless, we get a big shock from the debt ceiling impasse or from the Fed or something like that. So talk to me about, the debt ceiling impasse, because Janet Yellen just said, hey guys, we might run out of money a lot sooner than anticipated. It could be as early as June 1st. How concerned are you about this?
Well, as far as a short-term reaction, I'm really concerned about that. But as far as I understand, we're always in this situation where it's a big rush right to the end where we're going to run out of money. We're going to run out of money, and then at the last minute, the politicians save the day. When we see these types of moves where the market is truly reacting to whether we're going to run out of money, they're short-term moves. They're more kind of headline risks because how long is that going to take place? If we do go into default, that's a brutal thing. It's going to really, really hurt the markets. But how quick? How quick is that going to resolve itself? So if you're looking for Armageddon, I really don't see it. As far as whether we're going to avoid that, I really can't say. I have to think that we will, but I'm really looking past the risk and saying, what then? The biggest concern to me is that a big move down, a big negative reaction to what's happening will really wash out a lot of people, certainly a lot of my people that are in stocks and they think, okay, well, this is the worst, I got to get out. And then you're really getting out at the worst possible time.
And we're speaking with Dan Fitzpatrick. He's founder of Stock Market Mentor. So talk to me about the Fed's meeting this week. It's almost certain, right, that we're going to get a 25 basis point rate hike, but what do you expect the language to sound like?
Yeah, I think the language is going to be the same. I don't see Powell saying he's, they're going to shift or, well, they're going to pause. They've kind of said that, recently where, well, we're raising again, but we're watching closely. And, they always watch closely. So I think that ultimately we're going to get more of the same. And if the Fed does not raise rates, I think the market's likely going to react negatively to that because the question would be, well, what do they know that we don't know? And then the question, basically one of your first, questions to me is, what about the regionals? What else is out there? We know that when you turn on the lights and you see one cockroach, there's more than that. You just don't see them yet. So I think the market's going to be really concerned about that. If they raise 25 basis points, I don't really think there's going to be a negative reaction to that. I think more we're just going to start truly looking at levels in the market and wondering, waiting, watching to see whether these major indexes start breaking out because a lot of them are right up at key resistance levels. So I am looking past what the Fed does tomorrow. I just want to see what the markets do. I don't think there's going to be a negative reaction to 25. I don't really think there's going to be a positive reaction either. I think it's going to be just kind of more of the same.
Tell me, what are you hearing from traders the most? What are they asking you the most about right now?
Well, they're noting that the biggest moves have come in the mega cap stocks. That's what's really been propping up the market when you consider, the major averages like the NASDAQ, the composite, S&P, things like that. And so the big question is, are these moves in the mega caps overdone? Can I still be in them? Can I still hold them? Or should I be looking for something else? And, my reaction to that is, yeah, you got to stay in the mega caps for now. And here's why. Because nobody's going to get fired for owning Apple. The money goes right now where we're still in a credit crisis and the higher cost of money. Markets are going, traders are going to where we're safe. And that is they're going to the companies that don't need money. That's the mega caps. And so they ask me, do I stay in them? I say, yeah, stay in them, but also start looking for some kind of green shoots or whatever you want to call it in sectors and stocks that are really not watched very much.
All right, Dan, let us know what your Twitter handle is, where we can follow you, and where we can learn more about Stock Market Mentor.
Sure. It's just Dan Fitzpatrick. That's my Twitter handle. And yeah, so you can check me out there. Also on my website, Stock Market Mentor, you might want to sign up for my chart of the day. It's free, and I send out a free chart video every day. And the ideas of those are not really to sell anybody. It's just to help people make money and give you a good trading idea or a good take on the market. So, love it if people do that. I think it'll really help you out.
All right, Dan, it's been such a pleasure speaking with you. Thank you so much.
Okay. Thank you, Janet. Have a good day.
And Dan Fitzpatrick is founder of Stock Market Mentor.